If you have money sitting in a bank account, what I'm about to show you matters more than any stock tip or market prediction. Because over the last year, one silent shift has started changing how the entire US financial system works. And most people haven't noticed it yet. But the numbers are real, and they're getting bigger every week. 3 weeks ago, something unusual happened in the US financial system. Not a crash, not a headline, not a panic. Just a number. A number that most people never saw, but people inside the banking world noticed immediately. More than $40 billion moved out of traditional bank deposits in a single reporting period and into short-term government funds. No lines outside banks, no breaking news alerts. Just money, quietly leaving. And when money moves quietly, it usually means the people moving it know something most people don't. So the real question is not whether money is leaving banks. The real question is why. Because when ordinary savers, corporations, and institutional investors all start doing the same thing at the same time, it's never random. It's a signal. To understand this signal, you have to look at something almost nobody pays attention to: what banks actually do with your money after you deposit it. Most people think their cash just sits there waiting. But the moment money enters a bank, it begins working somewhere else. It becomes a mortgage, a commercial real estate loan, a business line of credit, or long-term bonds purchased when interest rates were much lower. Those assets don't change quickly, but deposits can disappear in minutes. That mismatch is the silent vulnerability in banking. And right now, that vulnerability is being tested, not by fear, but by math. Because for the first time in many years, savers discovered something strange. They could earn significantly more money outside their bank accounts, with less risk. Treasury bills, backed by the US government, started paying yields that savings accounts simply couldn't match. So people did something simple. They moved their cash. Not all of it, not dramatically, just enough to make a difference. And when millions of people each move a small amount, the total becomes enormous. That's exactly what's happening now. Money market funds, once a boring corner of finance, have quietly grown to levels never seen before. Trillions of dollars now sit there, earning steady returns. And every dollar in those funds is a dollar that is not sitting in a traditional bank deposit. That's where the real story begins, because banks rely on deposits like an engine relies on fuel. When the fuel level drops, the engine doesn't stop immediately, but it begins to change how it runs. Banks respond by lending less, by tightening standards, by being more selective. You can already see this happening. Small businesses are reporting that loans are harder to get approved. Commercial real estate refinancing is becoming more difficult. Developers are delaying projects. None of this makes dramatic headlines. But together, it slows the economy in ways that only become visible months later. This is how financial pressure builds, not suddenly, but gradually. And there's another factor accelerating this shift that almost nobody talks about: speed. 20 years ago, moving large sums of money required paperwork, phone calls, waiting periods. Today, it takes minutes, a few taps on a phone, and funds are gone. That changes behavior. Because when moving money becomes effortless, people move it more often. And once a trend starts, it feeds on itself. When investors hear that yields are higher elsewhere, they check. When they check, they compare. And when they compare, they move. This chain reaction doesn't feel dramatic, but it's powerful. And here's the part that should really make you pay attention. Not all banks are affected the same way. Large national banks have diversified funding sources, but regional and smaller banks depend heavily on deposits from households and local businesses. When deposits leave those institutions, the impact is much greater. That's why analysts are watching regional banks closely, not because something dramatic has already happened, but because the underlying conditions are changing. Financial stress rarely begins with a collapse. It begins with pressure, and pressure builds quietly. There's also a deeper layer to this story. Every dollar moving into Treasury bills isn't just leaving banks, it's financing government borrowing. So at the same time deposits are shrinking in parts of the banking system, demand for government debt is rising. That changes the balance of the financial system itself. It shifts where capital flows, and when capital flows change, entire industries feel it. Real estate feels it. Construction feels it. Hiring feels it. Sometimes months later, sometimes years later, but always eventually. Now here's something even more interesting. Many of the people moving money right now are not reacting to panic. They are reacting to opportunity. They're simply choosing higher returns with perceived safety. That's what makes this trend powerful, because trends driven by fear can reverse quickly. Trends driven by logic tend to last longer, and right now the logic is clear. Higher yields, easy access, government backing. Those three factors are enough to keep money moving. The real question is what happens next. Will banks raise savings rates enough to compete? Will interest rates fall, reducing the incentive to move money? Or will this slow shift continue, gradually tightening credit across the economy? Nobody knows exactly how it ends, but history gives us a clue. The biggest financial changes rarely arrive as sudden shocks. They arrive as slow shifts that only become obvious in hindsight. And by the time everyone notices, the system has already changed. That's why watching the movement of money matters more than watching headlines. Headlines tell you what already happened. Money tells you what's about to happen. And right now, money is moving. Quietly, steadily, in a direction that suggests the financial system is changing again. Not with noise, but with silence. And in finance, silence is often the loudest warning of all.